So what on earth is a profit and loss account? Well, I'll show you exactly what it is in this video. Hi everyone, my name is Simon Misiewicz, your Finance and Tax Director. I'm here to help you build your wealth and reduce your tax liability. And in this video, I'm going to explain to you what a profit and loss account is. And along the way, I'll explain why it is important if you are a small business owner or indeed a large corporate owner wanting to grow your business. And this may be relevant to anyone in the medical profession, especially if you're in the private sector, whether you're doing Botox, your dentistry or a GP, or you own a shop itself selling shoes or clothes. You could also be a property developer or an investor, or indeed if you're in management consultancy as well. All of these components for profit and loss will be important to whatever type of business you are in. And what's the profits and losses? There are key components that I want to share with you during this video. The first one is income, so basically your turnover, how much money you're bringing into the business. Then you have direct costs, I'll explain more about that, gross profit, overheads, and then eventually you'll end up with a net profits line. And hopefully that is an extraordinarily high number for your business. It would be fantastic if everyone's business had a high net profit. And I'm going to go into the first cost. So income, we know that's the amount of money that you bring into the business. The cost element, though, are split into three different categories, or they may be named in three different ways. The first one is direct costs, the second one is variable costs, and then we have this third terminology, marginal costs. And they essentially mean the same thing. All they are doing is talking about the cost of making the product or service that you are eventually selling. And I'm going to explain that in a bit more detail for you. Essentially, direct costs can maybe be split in two ways to make life a bit easier to explain. You may have people or you may have products, and it's basically the making of whatever you're selling. Sometimes if you're in the service business, you may not have products necessarily, you'll only have services or people in your business that deliver the service. But if you're making products, then you may have a mixture of the products itself and the people to manufacture or make those goods. If you're in a shop, for instance, you may just have the products itself and then maybe a few staff members to sell those on. So that's why I kind of mix those two up. Now, as I want to give you an example of how this works. So direct costs will change the way you along the way. So if your sales are increasing, you would expect your direct costs or your variable costs to increase as well. So let's take a look at an example here where you have a management consultancy, and typically if you are a management consultancy firm, you may well bring in from time to time additional resources as and when you need it. So if volume is stepping up, you might need more staff than you have, and you might get in third-party staff to help you. And that's what flexi staff are. So management consultants are labor intensive, and therefore they will have a lot more people inside of that business. And as a result of that, you will tend to find that your direct costs are all going to be people focused. Shoe shops, so if you've got a shoe shop or even any type of shop, but I'm going to focus on just shoes for now, and the shoe shop itself may have a direct cost of the buying of shoes from a warehouse. So you may not be making the shoes necessarily, but you'll be buying in from a wholesaler or a warehouse, and then you display them nicely and then sell those to the public. Ultimately, that is your main cost here. You may have commissioned staff members, so if you know that you're going to do a sales campaign in your shop or at a weekend, you may require additional staff to sell your products or your shoes. And that's when you might have a variable cost, which is temporary staff that you might use. So you may only want them for 4 hours on a Saturday one weekend, but then 6 hours another. And it is totally flexible. They are not your mainstays in the business whereby you pay someone 9 till 5. These are your flexible members of staff. Botox will be the same. So again, if you're in a medical practice, you may have locums. So that will come in and do a shift for you, especially when you're busy, or you may ask them to do extra few shifts at the evening time. And the products you sell, again, for the medical treatment, your products will be only purchased when you sell them. So that's why they're called variable and direct. They move with the sales demand. And if you're a builder, well, if you're building homes, for instance, you wouldn't necessarily need to buy lots of bricks until you want to actually make a house, build a house, and then sell it on. So again, your laborers, your materials of building bricks to build a house would change with the volume of homes that you're looking to sell in the future. So all of those are variable costs. They all change no matter what type of a business you're in. They will change with your sales volume forecasts. Let's go through an example here. So you have a shoe shop, Botox and builder. So we have income along the lines of £100,000. I want to make a comparison here. Direct costs, you'll notice that the builder has more direct costs. The reason for that is because essentially that is their main business. Their direct cost is building a house. They will sell a house for £100,000, but it might cost them £60,000 to build that particular house. They make relatively good gross margin at 40%, but it's not as much as someone who's doing Botox. The person doing Botox may be requiring to do work themselves, or if they've got employees, they may hire in people from time to time to do their work. So with direct costs, it could be that they use locums, or they could be using staff full time for this. But ultimately, Botox people will make a good margin because it's all in the sales price. They may not be working 9 till 5 full out, especially when they're first starting, but they will make a good margin on their products. It's one of those sexy products as well that people were willing to pay more, because if you've had Botox, you know it can go wrong, and therefore you want to go with a trusted person to get it right. And then eventually you've got the shoe shop. So again, as I mentioned before, you've got the main income of selling shoes. The bulk of their direct costs are the shoes itself, and therefore you would expect that the majority of their cost is going to be £40,000 with a gross profit of 60. Now, some shoe shops, or indeed any kind of shop to sell products, may be making gross profits between 40 and 65%. So I'm being quite generous in terms of these rates. But it does show you that types of industries that you work in will have different gross profit percentages. Gross profit, by the way, is just the difference between your sales, taking your gross profits, divide that by your sales times by 100, and that gets you your gross profit number and percentage. So in terms of what we're seeing here, you'll notice that the gross profit percentages across these industries are very different. So make sure, if you are trying to do comparisons, make sure you choose the right industry to make your comparisons on. So what I want to do is take a shoe shop as an example. And what you'll find is that typically you will have the income going up and down because of seasonal fluctuations. You may have weather conditions that doesn't help you on a weekend. If it's wet and windy, people might not come out. People do come out when it's good April, May, especially in the UK, but may not want to go to your shop unless it's air conditioned in July and August, because they prefer to be outside anyway. So you will always have this seasonal fluctuations, and you do need to forecast that into your business model, no matter what you do, especially if you're in the world of retail. Now, if you're a builder, again, you might have better sales during the summer months because you can work outside, you are more productive. But you'll notice on this particular graph, I'm just going to use my pen here just as I can. I'm going to show you that the rate of sales increases from 10,000 to 15,000. Please do note that the direct cost does follow suit in terms of that increase, and then they go back down again in terms of the income and direct costs, and it's linear. So remember, your direct costs of selling shoes to what you sell to the public will go linear fashion. So it will go in the same direction. You'll notice that the gross profit therefore kind of fluctuates between seasons, and then you've got your gross profit which is fixed at 60%. Now I'm going to do a different video for another day that talks about why gross profit percentages do fluctuate from time to time, but for now I just want to keep things really simple. Don't forget guys, if you really enjoyed this video so far, please give me a thumbs up as a like, and remember to subscribe to our channel so you don't lose out on every new video I release. Let's talk about fixed costs now. So there are terminologies we need to be aware of. There are fixed costs because they don't move. You've got overheads because it describes that you're in a building or a factory, or indeed indirect costs because they're not really attributed to the selling of a product or a service. So these are the things that do not really change that often. And the way I liken this is if you're in a building and the costs associated with that building may well be deemed to be your fixed costs or indirect costs, as I will refer it. So here we've got, you might have administration staff, so they're not really their focus for the selling of your product or service. They're really there to do your paperwork, answer the phones for sales inquiries, maybe order some stationery for you, but they're not necessarily there to help you to sell your product or service. You've got office costs, so you may have your lighting, heating. So the room that I'm in right now is heated. I need it to be hot for me, otherwise I can't really work very well. I've got a lighting system, so those kind of things again are going to be constant. I'm going to be in here most of the time. That doesn't really increase or decrease too much based on what I sell. Now, if you're a manufacturer, that may be slightly different. You might have a stepped variable cost, whereby if you are using a lot of power, electricity to make things, then that may change and fluctuate from time to time. But for this example, I'm going to say it's assumed at a fixed level. Stationery, again, it is pretty much, if you're maybe a management consultant, you will have pens and paper, but they won't fluctuate too much. If you're in a shoe shop, for instance, again, much stationery, you're not going to have that much difference from month to month. If you're in a printing firm, you may not want to have these as indirect costs in terms of stationery. You may want to say, well, these are more direct costs, because if I'm in printing, I'm going to be buying paper, I need inks, I need various other things to sell the brochures to my customers, and therefore I do have more demand on that particular product line. Well, that's more of a direct cost, and I would start to shift those up to your direct line costs. Communication, so your mobile phone, your fax machines, if you still have one of those. I mean, do they exist anymore? I'm not sure. I've done it. Apart from the squeaky noises, I really didn't like them, to be fair. But you could have phones, landlines. Lots of people are using now their laptops and tablets to make phone calls through the headphones. But typically, I would say they don't really change too much. You might pay a line rental. If you're a management consultant, they might fluctuate slightly because you're doing conference calls with your customers. But to be fair, it's not a great cost. And then your other costs may be legals, licenses, accounting. Those aren't going to be, they're necessary evils, if you like, to pay out and get done, but they are not really going to shift with your particular sales range, and therefore will be deemed to be an indirect cost. I just wanted to so in this example, you'll notice I've got a bunch of words that I've just mixed up that's relevant to those type of industries. The one thing you'll notice quite a lot of is stationery is popping up a few times, because most companies will use office stationery. You might have administration staff, as we've got highlighted here. But again, these are things that you are paying fixed on a month-by-month basis and don't really often change because your sales volume do. So those are stationary costs, don't really move. And here is the example that I've got for you in terms of the shoe shop, the Botox and the builder. You'll notice this time around that the indirect costs, or the offices, the warehouse that you might be in, or shop for the shoe shop, you'll notice that the indirect cost is quite high. The reason for that is if you are a shoe shop, you may well be in a retail space. high streets mainly, and that can be very, very costly, as opposed to someone who's management consultants that is using an office outside of the city centre. The builder, well, the builder cost for their overheads isn't going to be that much. They may even work from home or may use a serviced office that isn't going to cost them an arm and a leg. Why not sponsor our next video? Please drop me an email to understand the opportunities. Well, why not book a call with me, Simon Misiewicz, your Finance Tax Director, for at least an hour to understand how we can help you grow your business without paying the tax.